So good afternoon and welcome. So I'm David Kandziora, the chair of your friendly local CFA society. Today we wanted to run a ethical decision-making workshop for you. So I'll just run through what that is and also what it's not, so we're sort of all on the same page. I've had to, I guess we'll go through this housekeeping first. So, just usual rules, try and keep your microphone muted if you can. Of which I apologize, the council has just turned up with a giant wood chipper outside, which is great timing on their behalf, but at least they get round to some things finally. Also, feel free to sort of raise your hand or jump in with a question. It's sort of meant to be a Q&A sort of session. It's not really meant to be a lecture or a sermon in any capacity. Also, there'll be a chat, which CAIA will be monitoring. So again, feel free to put some comments in there. We'll have a number of poll questions as well. Some will just be to sort of get things started, and there'll be some ethical case studies where we're trying to figure out exactly what's going on and some of the steps, how we might decide on the outcome. And at the end, we're going to sort of talk to a few extra resources that you might be interested in. CFA Institute has a plethora of resources, really. You can go as deep as you want. There's online learning labs, there's various extra courses. And that also brings me to the next point. This will cover some of the CFA ethics code. It's not designed to sort of be a comprehensive coverage of the code. The CFA Society has done that in the past. There's already some videos up online in terms of walking through each section, what it means, what the standard is, and sort of how it applies. This workshop's more how to use that information. In particular, and I've already had to dissuade some people who thought they might get a couple of extra marks on the ethics exam coming up for their CFA exams. This won't be how to pass the CFA ethics exam. If you are interested in that, let us know, and we can always run a different workshop. There's almost a slightly different set of skills for sitting the CFA exam and collecting the multi-choice answers versus the actual practical real world, how you might go through solving an ethical conundrum. So on that, what we want to do, we want to focus on taking action, what you might actually do, so some practical steps, how to resolve things, adopting a sort of that practical decision-making framework, and an in-depth look at a few case studies. So on the agenda today, we've got the CFA Institute Code and Standards. Again, I will just run through them briefly to remind everyone what they are, but we won't go into them too much. There's also the ethical landscape of where we stand as finance professionals, general trust with consumers. It's quite interesting. There's also a section on situational influences and how that affects our ethical decision-making. Then we'll sort of step through CFA Institute's ethical decision-making framework itself. And finally, we'll grab that framework and apply it to some case studies. And if we've got time, there'll be a little recap at the end. So here's just a practice question. Just Kylie's going to conduct some Zoom polls today. And this is just a function so that we can primarily gauge the audience as well as getting you used to the polling questions. So if you've got some time, Kylie, if you could just chuck that one up, then we'll vote on that, give you a little bit of time. You can see how it goes. Then we should also realize, better understand how the collective level of experience with everyone on the call is. After you've all voted, it will come up and it will display the results. Oh, exciting. I get one too. Might as well fill it out. Oh, I see there's two questions there, Kylie. Let me just jump to the second question then.
Yeah, sorry, just ignore that one underneath.
Oh, I think you might have to chuck it in to make it work.
Oh, okay.
Yeah.
Oh, well, just put an answer in there. Sorry about that.
What is the second one? Well, sneak preview. Oh, okay, that's a bit bigger. All right. Choice 2 doesn't matter. Cool. We'll let Kylie tabulate that one. Also appreciate there's going to be a number of non-CFA chart holders on the call. Something quite unique about the New Zealand Society is that we've got that associate membership, which we've had fairly good feedback on. We're always trying to find ways to serve both the associate and the charter holder members of the society. How's that looking, Kylie?
I've just got a bit of a, I just pushed the download results and something very strange has happened. So I'm a bit worried about that.
Are you deep in the CSV files?
Oh, I hope I don't muck this up by.
That's all right. You can always just tell us verbally if you like, in terms of just rough.
I can't even see it. Oh, here we go. Sorry. Share results. Is that showing me now?
It is. Thank you. Wow, we've got a few seasoned veterans here. 10+ years is actually looking pretty big. Unless we have a poor sample and I skewed the results. Cool. So we've got a few less than 1 years, a few mid-pack, and a few at the end as well, and a few NA. So I'm guessing the NA is the associate members, which is interesting too. Thank you. The second question that we've got was sort of just in terms of identifying where you might be coming from in terms of background, which would be quite useful. If you could also chuck that poll question up, Kylie, and we'll also have a look at that. Thank you.
Would you like me to end that poll now, or?
Yeah, if you think you've got enough people. Cool. Let's look at that one. So mostly other. So that means we've done a poor choice on selecting options. That's interesting. Investment advisor comes up a fair amount, and a little bit in the teaching side. Cool. That's useful to know too, just so we can gauge when we're going through some of these case studies. Like if we were all charter holders, we wouldn't sort of go through the standards in too much excruciating detail. It's good to just know where you're starting off as a base. So just in terms of the CFA Institute Code and Ethics, there's the the standards of professional conduct, and there's also the code and standards. So on the 12th of May 2023, there were actually some changes. So if you like to get excited about that sort of thing, there are going to be some changes on 2024 ethics. There's going to be a new ethics code. There are 3 main changes to that, and we'll label those changes when we sort of come to the applicable sections a little bit further on. So obviously members and candidates, and we'd like to have associate members as well, want to maintain the highest ethical standards. We've also got one way to sort of accomplish that is workshops such as this one. That sort of shows that you are committed to that process and have an interest in it, and it's actually an important part of how you function. And you'll be pleased to know that this module qualifies for continuing education credits and SER ones at that, which are actually quite tricky to come across. So that will be useful. We also obviously want members and candidates to adhere to the code and standards. So if you've got a document on your left is the code and standards, and the document on the right is the standards of professional, hang on, I have to get this one right, standards of practice handbook, the SOPH. That's just a much more in-depth version, got a lot of actual taking case studies and examples for each of them, whereas the left-hand side's more, this is what we want to happen. The right-hand side's actually quite a good detailed option for you if you want to look into actually understand the standards a little bit more. And if you are sitting the exams, that would be also a good one to look at, the actual application of those standards. So it's one thing to sort of memorize the left-hand side in terms of this is what you must or should do. The right-hand side's quite good in terms of figuring out exactly what that means in particular circumstances. And of course, just like in real life, exam questions will come where it's a gray area and there might be a number of avenues to take. So there'll be a new standard, I keep wanting to call it SOPH, the Standards of Practice Handbook. There'll be a new version of that in 2024. Not sure as yet which exam that will first apply to. But that is obviously coming up, and any major changes you want to be on top of, we'll go through those shortly. So as part of agenda item number 1, when we're looking at it, we want to identify all the standards and the components involved in the standards. So CFA Society NZ already has done that deep dive. Like I was saying, there's already a number of videos up on these standards up on YouTube. So feel free to just go back to watch those. We don't really want to reinvent the wheel. That's already been done. So we'll take a slightly different angle this time, but just outlining them in general. So we've got standard 1, professionalism, that covers knowledge of the law, independence and objectivity, misrepresentation and misconduct. So of the 3 revisions I was talking about before, effective from next year, there'll now be a new standard requiring members to achieve and maintain competence. So again, one useful way to demonstrate that would be attending workshops, seminars, and doing CFAI's continuing education to show commitment to that. So that will be a new standard, and that will come forward in the new Code of Ethics from next year. Standard 2, again, deals with material non-public information as well as market manipulation. One of today's multi-choice questions sort of at the end in the case studies will be dealing with one of these, so bear that in mind. Also got standard 3, loyalty, prudence and care, fair dealing, suitability, performance, presentation and preservation of confidentiality. That all sits under sort of the global umbrella of duties to clients. So again, this will be coming up a little bit later when we're looking at some of the case studies. And when I was talking before about the new additions to the code in 2024, there's also going to be an update in this area. So from January 2024, there'll be a new standard looking at disclosures to clients and relating to the nature of the services provided by the members and candidates and the costs to the clients for those services. So a fundamental goal of the code and standard is to protect client interests and allow clients to make fully informed decisions about their investments and their own financial well-being. And so giving clients some information about the nature of those services, what they can expect from investment professionals, and actually like the true underlying costs of what they're getting into and how they'll pay for those services, it's critical to achieving those goals. Starting to see that come across a number of jurisdictions too, with regards to regulators, ASIC, FMA, and in the UK as well. So this will also come up a little bit later when we're dealing with the case studies. So duties to employers, just as a recap, involves loyalty, additional compensation arrangements, and responsibilities of supervisors. Standard 5, investment analysis, recommendations and action, diligence, reasonable basis. We've also got communication with clients and prospective clients, as well as record retention. Again, we're going to look a little bit more at this in depth when we do some of the case studies, these standards in particular. So we obviously want candidates and charter holders to exercise diligence, independence and thoroughness in making their investment recommendations, as well as taking investment action. So, you know, as has cropped up obviously in exams and in real life, you want a reasonable and adequate basis supported by appropriate research when you're giving those investment recommendations. Starting to round things off, we never quite get there. These keep going. So we've got standard 6, which is conflicts of interests. So again, this will come up a little bit later when we're dealing with the case studies. Members and candidates obviously want to ensure disclosures are pretty prominent in what they're doing. It's delivered in plain language. The information's got to be communicated very effectively and at a sort of sufficient tone or level for the recipient to understand. Got to be plain language. Also, the final sort of update in terms of those changes to 2024 that I was talking about, again, as of 1st of Jan 2024, the current conflict of interest standard is going to change. So it's going to add language that requires members and candidates to avoid conflicts of interest and disclose those conflicts. Currently, the existing standard, there's no mention of avoiding conflicts of interest. So that's just a slight tweak to that one. You actually have to enable, there's actually got to be positive action to avoid that conflict, not just disclose that conflict. Finally, also there'll be, well, we won't be going into this standard later in the workshops. this can be dealt with in other workshops, but again, this one's a little bit more self-explanatory. It's more around CFAI IP. So responsibilities as a CFA Institute member or candidate. So there's participation in the exams and programs, and there's also a reference to the designations. So when I was running through the agenda before, the second item on the agenda was looking at a brief overview of the ethical landscape. So in terms of doing that landscape, we wanted to look both at sort of how the public perceives the finance sector, but also before we jump into like ethics, I thought it would be useful to actually stop and think, well, hang on, what is ethics exactly? And why do I care? So the couple of points up here. So I've thought the best way to do this was to put up some quotes by people smarter than myself to make myself both appear smart and also to actually stop and reflect on what's being said. So when you look at some of these, I think it's easy just to sort of take quotes and sound clever or signal virtue. But, these towering giants here, they've spent a lifetime distilling key concepts into, sort of sometimes 1 to 3 books across their lifetime. There's often actually a reasonable amount of wisdom here that you think may not apply because it was developed a few thousand or even a few hundred years ago, but they've actually come across the same situations and resolved it quite well. Particularly in terms of what we're dealing with CFA ethics here. I think Confucius has actually got some pretty good quotes there in terms of being able to identify and resolve situations, and also the cost of not resolving those situations. So, and I don't think you can really talk to ethics without at least tipping your hat to Aristotle. So with Aristotle's ethics, it's more of a study of character, which is built around the premise that one should achieve an excellent character, sort of like a virtuous character, as a precondition for attaining happiness or well-being. And he identified a couple of types of virtue. One would be intellectual virtue and the other would be moral. So in separating those out, you might learn intellectual virtue by instruction, and you might learn moral virtue by constant practice or habit. So we're all born with the potential to be morally virtuous, but it's only by behaving in the right way that we actually train ourselves to be virtuous. And another sort of important distinction here is between compliance and law. So you'll often see the law ensures that people conform to a set of required behaviors. You often see this dictated as that you must do X. That will involve almost coercion. Ethics, on the other hand, is more encouraging people to behave in a way that's consistent with the organization, its values, and its mission. So that it will often be couched with phrases like, you should do this. So again, it's not mandatory, but it's more of a moral obligation. We often also make unethical decisions, not because we're bad people, but because of psychological biases, social and organizational factors, situational influences, and also outside decision making. So when you're thinking about these biases, which we'll go into a little bit later as well, organizational factors and situational influences lead to weaknesses in sort of how we process information, and sort of that doesn't really help us make decisions particularly well, and it can lead to unethical behavior. So, the point of putting this all together, what we want to have is effective ethical thinking. And so if we can demonstrate that, then you can increase the likelihood that you'll notice and be able to act on ethical issues before they become destructive. You'll also be able to better recognize ethical dilemmas, and that sort of helps by exposing yourself to these situations and having some training in them. Some situations are going to be more predictable than others, so it can be quite useful to actually pre-identify what could go wrong and what you might do about it. And also quite good to understand the fundamental underlying principles, and also to develop that decision-making framework for dealing with ethical issues. So again, the point of the workshop was to sort of introduce CFAI's ethical decision-making framework, and hopefully that gives you at least a base to step through. Here's a framework that I can use to apply to an ethical dilemma. So this one was interesting. So this was more, how do we measure up compared with other industries? So looking at retail investor trust across a number of industries. A couple of takeaways here. So when I look at it, you can kind of see the 2022 survey results showing the perception of financial services. aka the investment profession, compared with other industries. So you can sort of see the investor professions improved since the 2020 survey. So it's obviously gone up. On the right hand side, you've got the change. So everything's increasing. There is an increasing level of trust, but we're still actually a fair way down in terms of what people believe that they can have trust in. For example, medicine's obviously pretty high up there. Technology, interestingly too, quite high up there. I wonder if that would still be the case in 2023. Obviously, it is surprising that law actually didn't rate quite as highly as financial services, but it's entertaining to see the media and entertainment and the government sitting at the bottom of that chart. What we'd obviously love to do is to raise that as highly as possible, because only then can you actually have a decent functioning relationship with clients and investors. So here's another slide from the 2022 survey. So looking at, do investment professionals deliver what is important to the investor? So we've got the green line there showing the importance to investors, and the blue line showing the investor's perception of that delivery. So clearly there's a fair way to go in terms of meeting expectations from clients in this area. Just give you a second to digest that one. It's quite interesting. I'm not sure you'll ever close the gap on whether people are happy to pay fees, but obviously like to make sure that people understand what they are paying, how much, and whether they're happy with it. Third item on the agenda was sort of looking at a brief overview of the situational influences that can cause us to stray from the ethical path. So there's another poll question coming up. So this is more looking at which has more influence on whether a person will engage in unethical conduct. Is it disposition or situation? So we're launching a poll question on that, so you can vote shortly. Encourage you to go with your first thought. It's not an exam or anything. We're just interested to see how you guys feel about this. We could hear and say there's no right or wrong answer. Can obviously be person dependent as well.
In poll now.
Why not? Ooh, look at that, down the middle. Situation by a whisker. Shouldn't have voted. Outside circumstances. Well, that's pretty accurate. So, I mean, a lot of the time, and I guess the point of it is there's an underlying moral character which sits there. Obviously, you can do a bit of work on improving that, but situational influences are apparently extremely important and can push people over the edge. And it's not in terms of being good or bad, sort of going back to those quotes a little bit earlier. It's not that anyone's decided to be good or bad in a particular situation. They just may not have thought. And that leads to that slippery slope where you might actually take some choices that weren't quite as good as you might have thought. Cool. So looking through situational influences, here we're going to sort of look at the most obvious situations that can influence a person in engaging in unethical conduct. So again, quite like, because we're all financy people, a lot of economists like to write things about this and try and quantify it and put some utility curve on it. But there is a reasonable identification that people are really homo economicus. They are personal wealth maximizing opportunists that will lie, cheat, or steal whenever their own personal calculus indicates that such behavior will maximize their own personal wealth. That was a quote sitting in the Financial Analyst Journal in terms of John Dobson having a look at a study in 2005. He was looking at sort of values-driven leadership being built around and preparing for values-based action. So, in terms of figuring out where that leads to, questions would be, how do I learn and act on my values? What would I say and do in a particular situation? And how can I be the most effective in acting on my own values? You just see, yep, cool, that comes through. So one of the main situations here is that obedience to authority. So this can be authoritative figures who condone unethical behavior for economic gain, particularly in firms. And again, we'll run through some case studies later. The conformity bias, where everyone else might be going along with a situation, pushes people to conform. They can have a potentially unethical corporate culture. Might be a self-serving bias, which inclines decision makers to gather and process information to advance their own self-interest and support their own pre-existing views. There's also sort of incrementalism, where you might take a small step to start with and it just gets bigger and bigger. Spoiler alert, we will talk about the LIBOR scandal a little bit later. So that was one where it sort of started off pretty small, not mattering to many people, and then suddenly grew. Incrementally, you might argue it hadn't had much change, but actually from start to finish, it was pretty big. We just grab that next one. So is that conformity with others? Like I was saying, that sort of kind of goes hand in hand with the obedience to authority. If everyone else is already following the unethical sort of potential corporate culture, then there might be that conformity and wanting to fit in. There's also issues around ethics versus compliance. Like I was saying before, what you have to do and what you should do may not necessarily be the same thing. It's very easy to sort of think, I don't have to do that, therefore I won't, but it doesn't necessarily mean it's the best ethical course of action. We've also got regulations, quite notoriously reactive. So when we are sort of thinking about compliance issues, there's often a lack of resourcing in that regulator function. So knowing the rules is one thing, but it's quite easy to miss the forest for the trees. So far better off actually having an underlying understanding and commitment to culture of integrity and understanding the direction of travel for the regulatory landscape than sort of just trying to read the rules and make sure everything's fine. The aim here too wasn't to sort of necessarily give a set of rules, because obviously that's not going to apply to all circumstances. And so that's the reason a framework's been delivered, to actually help you think through the situations. Now we'll jump on to the ethical decision-making framework itself. So this is delivered from CAIA. They've got a 4-step or 4-phase sort of to their EDM framework. So we'll briefly have a look at those, and then we'll utilize the framework later to help us with the multiple choice sort of case study questions. At its core, the EDM framework can be utilized for sort of everyday decisions, and even outside the investment profession. So think of the EDM as a framework or a toolbox to help navigate life. CFA Institute framework, where they want to go is basically have it as a tool for analyzing and evaluating ethical scenarios. So that, particularly in the investment profession, but like we're saying, it doesn't always have to apply there. So there's an identify side of things, consider, act, and then reflect framework. And that should advance the decision-making structure for situations that often fall out to clear confines of right and wrong, which, to be fair, is a lot of situations. So it's not meant to be like a linear model or a checklist. It's meant to be a sort of that decision-making framework. It's meant to summarize the key elements of making a good ethical decision. So the framework's offered with the understanding that there's a likelihood that there'll be additional influences, and there might be unique actions for each scenario, and might go beyond what we describe. First step, so looking at that first part of the framework, was to identify the issues at hand. So as discussed in the presentation, situational influences can make it difficult to identify ethical dilemmas. The first step is going to be to identify, so it encourages you to actually stop, step back, focus, and become aware of those situational influences that might be acting upon you. Situational influences will be addressed in the next step when we talk about the consider aspect. So second aspect is to consider your options. So when you might be seeking additional guidance, avoid relying on those who might be inclined to agree with your perspective. Again, look at the financial incentives, or look at the culture that might be ingrained to make you think that way. This doesn't necessarily revolve around what people are doing around you. It's more revolves around the correct ethical choice. So instead, you should seek opinions and feedback from a diverse audience. At times, that could be accomplished by going outside your organization, so long as you're required to maintain confidentiality. Third step in that framework was to sort of make the decision. Fourth step was to actually reflect on the outcome. So it might be, what did you do different? What would you do differently next time? Was there anything that sort of led to that situation that may have been undesirable that you would then course correct next time that situation happens? You might perform differently. So the framework's meant to be deliberately so. It's meant to be a circle. So after reflecting, you might need to return to step one and go through the 4 phases again. And here we are back to the original layout of the framework. So it's sort of meant to be this continuous snake eating its tail, just in terms of you're not necessarily done after 4 steps. After you sort of reflect on those actions, you might think, hang on, I need to reconsider, and I might need to change my actions as well. Agenda item number 5. So now that we've shown you the 4-step EDM framework, we'd like to apply it to the situations. So we're going to reference the code and standards raised in these questions, but again, it's not meant to be like an exam level sort of option. It's going to be interactive. So we're going to launch some multiple choices to the question, but again, feel free to put your hand up, jump in on the audio or on the chat function. You'll get to vote on these, and we'll talk about the collective responses. So there are 4 main questions here that we're meant to generate discussion as part of a workshop. It's not necessarily meant to have a single correct answer and did you get it right, did you get it wrong? It's more about the process to get there. So we also recognize that of the answers there might still need to be an additional component to make it a better answer. Why we like case studies is because it's all very easy to have sort of quick multi-choice questions and very black and white answers, but I guess the devil's in the detail. So I think case studies are a particularly effective method of learning ethics, both in terms of hypothetical scenarios, but later we've also got some cautionary tales where ethical concerns weren't taken into account and they quickly blew out. So the goal wasn't necessarily to learn the correct course of action of you should have known it was B. It was more that you should construct and develop that framework to help form what you might do in those situations. So again, giving you that real world example hopefully solidifies that process. So we've got case 1. I will read it through in case you're sitting there on the audio multitasking in your email box. So we've got Jenks. Jenks is an analyst for an asset management firm. So it attends a presentation for securities analysts at the headquarters of a manufacturing company. During management's presentation, the CFO discloses information that Jenks believes will have a likely negative effect on the company's stock price. Seeking to protect his firm's clients, Jenks immediately provides the new information and his updated analysis to the fund's portfolio managers. Jenks also sells his stock in the company. Jenks, A, acted properly to protect his client's interests. B, should have disclosed the information on his firm's website. C, should have disclosed the information to the firm's portfolio managers, but not have sold his stock. Or D, should not have discussed the information with the fund's portfolio managers. So have a read through that as well on your own, consider the options, and then chuck that into the framework on the right-hand side there. So we're going to be looking at the consider options, what are the situational influences, what are the alternative actions, what sort of additional guidance could there be? And then on the, what else have we got? We've got the reflect side, would be quite useful, and then sort of what the decision might end up being. So go through that, and then we can have a chat after the results come in.
Should I launch the poll now, David?
Yeah, sure. Yep, thanks. I've got PTSD from CFA exam questions, thinking this is all coming. It's all come back.
Right, here are the results.
No, interesting. So a fair number. So we've got 30% looking to say he acted properly to look after his clients with the information that he had. There's a few saying he should have disclosed the information on the website. And we're sort of battling it out, first and third there on the end. He should have disclosed the information to the portfolio managers, but not sold his stock. And that he, coming in, where is that? Third, they should have discussed it with the information with the fund's portfolio managers. Interesting. Cool. Well, so we'll step through this one. So in this case, so identify the issues. So when we're thinking of considering the issues, we've got Jinx, the information heard. It might be material non-public information. And if it is material non-public information, would it invoke standard 2A? If it's normal non-material, then it's not obviously a concern. So in this case, Jinx, he's already acted, so that's sort of one issue. He's told the funds portfolio managers at the firm, and also that he's sold the stock in the company. Did he act properly? Well, it sort of depends on whether you think the information is material or non-public information. So if it was, then he's violated the standard. So even if it's not material non-public information, Jinx's actions do violate standard 6B, the priority of transactions, where you're dealing with yourself before the clients. Standard 6B requires investment transactions for clients and employers to have priority over investment transactions in which you have an interest. What could Jinx have done differently? So in terms of re-identifying the issues, should consider the options, obviously go through that, take action and reflect. Of the options given, we think C is the most viable answer in this scenario, but only if the information is not material non-public information. If the information is material non-public information, then none of the answers would have been acceptable. And so that's often where things get a little bit tricky, both in the CFA exams, but also just in terms of real life. There's, the rules are fairly clear in terms of if you know it's material non-public or not, then there's a course of action. But actually figuring out what that means and how that information is being disseminated is actually quite tricky. One of the ways, if it is that sitting in that grey area, which CFAI does recommend, is encouraging the portfolio company to actually publish that on their website or to all analysts as soon as possible. And if it's out, if it's formally out in the public domain as wide as possible, that's a good way to make sure it's not material non-public information. Any comments on that one at all from the gallery? Otherwise, we can jump into number 2. So we've got Craig managing money for an investment firm. Because his personal investments always track closely with his clients' investments, e.g. he sells his stock when, hang on, I can't quite see the one, I have to grab this. Because his personal investments always track closely with his clients' investments, e.g. he sells his stock when he sells the stock for his clients, he believes he does not need to disclose his investments to his clients or his employer. Craig now must liquidate a large portion of his holdings to pay for university expenses for his twin daughters. Craig's actions are: A, acceptable because there's no conflict between Craig's personal investments and those of his clients. B, acceptable because he ensures that his personal holdings mirror the investments of his clients. C, unacceptable because Craig should not be investing in securities in which his clients have an interest. Or D, unacceptable because he was not sold the investments for his clients as well. So again, have a look at the framework on the right-hand side there and try and put that in and turn the handle, see what you come up with. Maybe launch a poll in 30 odd seconds or so, Kylie, if you like. Or maybe a minute, give people time. Cool. So poll questions. Two clear answers there in terms of audience participations. That's interesting. So we've got main answers for it's acceptable because there's no conflict of interest between the personal investments and those of his clients. And also the opposite of that, unacceptable because Craig should not be investing in securities in which his clients have an interest. Alrighty, so let's step through. So when we're looking at this particular one too, we want to identify the issues, that first part of the consideration side of things. So we've got Craig, he's closely aligned his personal investments with those of his clients, which is not necessarily a bad thing. Craig does not disclose this fact to his firm or his clients, however, so that's not so great. Craig must now liquidate that large portion of his investments. So consider options. Also down to figuring out what actions he could have taken. He could have more likely had to think about the potential effect of what this would have looked like in terms of you don't want to look like you're going against what the clients are doing. If it is a situation where you do have different personal opinions to that of the firm, you're allowed to obviously have that, but you want to be communicating to clients why you might be going the other way to them in terms of if they're investing one way and you're investing another. It's not a particularly good look. But if it is actually documented that he needed to grab the cash for a particular purpose, then that's obviously less bad. What can Craig actually do to prevent the dilemma in future? So as with the prior case, we've got a few standards coming involved here. So there's standard 6B, conflicts of interest, and particularly the priority of transactions. Is that conflict of interest around disclosure of those conflicts. And there's also duties to clients in terms of loyalty, prudence, and care. Of those answers, we like A in terms of if there's A's applicable as the correct answer only if there's been proper disclosure to his clients and the firm. Otherwise, none of the answers are acceptable. So again, there's a very specific nuances to pick up on. And generally, more disclosure is better, just in terms of making sure both the firm is happy and the clients are happy. And with that additional transparency, obviously everything can function quite a lot smoothly.
There is a question there, David, but I'm sure it seems like you've answered it there.
Oh, okay. I can't see that. You're welcome to read that out if you like.
Oh, it's just about the bigger issue that the fact that Craig hasn't disclosed the investments and resulting conflict. So yeah.
Yeah. So I mean, again, that was the best answer. Is the answers listed here aren't necessarily the 100% best answer. We were saying before that you might want to build on those. So in this particular case, you do want to start with one and then add to it. So A's okay and the best option of the ones available, but obviously the best course of action would have been to disclose everything at the start. Avoid the situation to start with is always a good answer with disclosures and transparency. So we've got another case study here. I'll read that one out as well. So we've got Irena, the financial advisor to several high net worth clients. One of her clients chooses all his investments and follows a very speculative course that Irena would not recommend for any other client. Until recently, this course of action has been successful, but lately the client's investments have been hard hit and the portfolio has lost more than 60% in value. The client files a complaint against Irena for facilitating the poor investment decisions. Should she have A, refused to buy the investments for the client she knew to be too risky, B, refused to accept the client unless the client gave her full investment discretion, C, had the client sign a waiver releasing her from responsibility prior to every trade, or D, accept the orders from the client but actually invested the funds in more suitable assets. Cool. Again, we'll have a look through that framework. You'll notice no one ever comes to you when you make them 60%. It's always on the other side. Cool. Those answers have come through. Wow, look at that. We've actually got a consensus. So most people are looking at, had the client sign a waiver releasing her from a responsibility prior to every trade. Interesting. So that had 90%. The rest, no one liked D, fair enough. And a little bit for A and B. Cool. So again, stepping through this, figuring out, what are the actual issues at play. So issues being one of Arena's clients chooses all his own investments. That's obviously putting you on the back foot to start with. And the client's investments are now performing poorly. So it's obviously why things start to heat up. And additional issue is the client filing the complaint. So what are the options? Yeah, a complaint has been filed. So, you're already down this course of action. You've got to figure out what Arena's options are now in terms of figuring out actions. What can she take now? What are we going to look at in terms of preventing the scenario from happening again? So questions to look at would be, has Arena violated any of the code and standards? What has she done to document this client's investment decisions? Is it actually clear that the investments are chosen by the client or actually by Arena? Because that's pretty important in terms of if they haven't performed. Or has the client been advised that by failing to take her advice, he might be accepting unacceptable risk? We've also got, so the question would be around 5C, investment analysis, recommendations and actions. Also, obviously you want members and candidates to sort of develop and maintain appropriate records to support their investment analysis, the recommendations and actions, and other investment-related communications with clients and prospective clients. When this was filtered through the CFAI algorithms, B and C were actually reasonable answers. So that was, I don't know if that's called a cop-out or a trick question, but somewhere in between. So she could have taken additional steps to protect herself. And some of this might be under the regular Know Your Client updates. So again, it would be meeting with the client fairly frequently. It would be figuring out what the arrangement with them is, being particularly clear on how that investment relationship was going to work. And there's a pretty good question around here whether she actually has a discretionary portfolio, because if the client wants to trade everything, or similarly, if you actually have to get authorization for every trade, it's not really sounding like a discretionary account at all. But if that's what the client wants, then you'd be obviously in your best interest to go out and make sure that that change to that normal arrangement has been accepted by both parties. You'd obviously also want to make sure that the risks of choosing that course of action have been presented. Cool. So this was the last of the CFAI case studies. So we've got Ewan, a research analyst covering global travel and lodging industry. He routinely met with the management of companies. She discovers and visits the facilities before drafting and updating her research reports. Because of recent travel restrictions on travel at her company, she's not able to conduct the type of thorough research that she did in the past. Nevertheless, Ewan's employer is demanding updates on her research. Given the swiftly changing environment for the industry, what should Ewan do? So we've got A, provide only factual information about the companies and refrain from any analysis until she can resume her normal research practices and form a well-researched opinion. We've also got B, conduct her research as best as she can due to the restrictions. Also C, provide no information on how she conducts her research, as that is proprietary information on the firm. Or D, provide research, but make no mention of how the research process has been affected by the travel restrictions. Cool, might as well chuck that up, Kylie. Thank you. Cool. So results come in nearly 50-50 split between A and B. So providing factual information only and conducting the research as best as you can. In terms of CFAI on this one, so identifying issues, we've got Ewan conducting on-site visits for preparing research reports. That's what has been happened in the past, but due to restrictions, obviously unable to do that. And her employer demanding updates on the research. So again, considering some of the options, when we're looking at some of the applicable standards, you'd be looking at 5A, diligence and reasonable basis. So on that standard, you've got candidates and members having to exercise diligence, independence and thoroughness when they're making their investment analysis and recommendations, as well as taking investment actions. You've also got reasonable and adequate basis supported by appropriate research and investigation for any analysis, recommendation or action. So figuring out what the best option should have been and then how she could make any disclosures. The CFAI machine, turn the handle on the framework, comes out with B in this particular case. But again, B with appropriate disclosures about potentially affecting the research. So again, the common theme through most of these has actually been pretty clear at the outset on identifying what the process is and communicating it to people, and where there are issues that may complicate that process, again, also identifying those issues and disclosing them to people so then they can make their own decisions. Again, you might change your mind on the contents of a research report if you knew that there was say a personal shareholding sitting underlying the person who wrote it. We'll also sort of add a cautionary tale. So this is a sort of a situation where you're a successful derivatives trader doing arbitrage trades, generating small profits by observing market inefficiencies. So your days you're sitting on the trading desk and you're buying and selling futures contracts on the Nikkei index. Upon obtaining a stock exchange license, you start making large unauthorized trades on the Nikkei index, which are no longer arbitrage trades. So this is sort of outside your original remit. The trades actually go quite well, though. The bank's very pleased. Record profits are made, and management encourages you. It says, thanks very much. Here's 3 times your salary and bonus for the year. Good work. Question, can you continue to trade given the bank is aware of your actions, i.e. they condoned your behavior because they've acknowledged it and are financially rewarded for the trades in the past? Question being, can you continue to trade in this manner? Oh, not many said yes. Interesting. So most said no, and a few said it depends. So old Nick Leeson of Nikkei fame. Some of you might be old enough to remember his glory days back in the 80s. I think he still goes around giving talks to various institutions on his ordeals. So he took this as basically management have acknowledged that he's, changed strategy. They're obviously aware of it, and they were rewarding him for it, so they understood it. But of course, when everything blew up, they changed their mind in terms of saying what was acceptable. So Nick obviously didn't fare too well out of this. He started taking on riskier and riskier trades. He also then started hiding some of the trades, which is not the best way to go. And then eventually the trades got so big that he tanked the bank, which is not a great place to be as well. So roughly 2.1 billion pounds in terms of trades. For those of you who sort of like the details, he actually had a short straddle sitting on the Nikkei. So basically you only make money on that one if there's not much market movement, if there's it's basically a low vol strategy in terms of nothing's going to happen. It's sort of insurance policy. So normally that's quite a low risk trade and you would collect a very small premium. But unfortunately, overnight, you had the Kobe earthquake and that broke the index, and then any options on that index just went bananas. So that wasn't so great, and the bank became liable for the losses and bailouts. About 1,200 employees lost their job, and Barings Bank, being founded in 1762, disappeared down the plug hole. So not so good. Leeson was apprehended in Germany 6 years later on charges of fraud. I can see we're starting to press up against the time there, so I'll just sort of let you read this and a little bit later. Should you wish, we'll circulate some slides. We've basically got another derivatives trader. Again, pretty similar situation to the first one, which is why I think we didn't really need a second poll. But again, exactly the same situation where management's quite happy that you're making a lot of money. Management acknowledged what you're doing, gave you bonuses, and everyone was happy. But again, once things didn't work out, then there starts to change. So even once this got to court, there was actually notice that the occasional negligence was not actually at fault here. It was managerial choices that led to the loss of funds. But that obviously enabled Kerviel to get away with his criminal acts, and it was by the hands of management, but it didn't stop him getting sentenced to 3 years in prison. Another one here too. So this, again, I'll let you read through a little bit later, should you wish. This was more a little bit more recent with the LIBOR scandal. And where this was quite interesting too was there was, again, that sort of crept into that incrementalism and overconfidence side of things. So it didn't involve too many people to start with in terms of tampering the LIBOR rate, the interest rate that settled between banks in terms of a lot of derivatives and a lot of contracts. But about 45 people in UBS were involved in the rigging, and various discussions on internal chat forums turned up that were looked at later by compliance staff. What this led to is obviously UBS getting in quite a lot of trouble. But why it's interesting too is a lot of this involves some of the concepts we were talking about before. So the incrementalism side of it was quite small to start with, but then grew in scope. But if you take, where you started and where you ended, you're thinking, oh, how did this end up there? There's also the, again, which comes with overconfidence side of things, is another one that's trotted out, the victimless crime. So it's very easy just to say these are financial numbers that they're rigging. But he was, in terms of the defense, was saying 99% of the trades were with unsophisticated investors. It didn't really matter. So that was obviously not a particularly good place to start. Fraud had pretty massive downstream effects when you think that it affected everyone's mortgage rates within the UK. So, I mean, every single person was very likely put at risk and having to pay due to this sort of corrupt practice. Morals of the stories, I'm starting to think the answer is don't be a derivatives trader, but the things to take out of it would be the road to ruin is paved with good intentions. So a lot of these things weren't actually people trying to be fraudulent. You do some trades and people actually pay off and say, good work, that's really good, let's keep going there. But again, once it all goes pear-shaped, then they're not there to support you. So again, we shouldn't say don't be don't rely on other people or sort of that group think to think this therefore makes it okay. You should always refer back to grab your little CFA standards practice handbook. It's a good place to start. Don't assume as well. Again, also thinking that we're all predisposed to make errors and suffer from biases. And ethical behavior often calls for courage, and which can be detrimental in the short term. So there's a few options here when you think, can I live with myself in the long term? One I quite like is the old Buffett newspaper test. He's pretty curmudgeonly old fellow. So in terms of his clever quotes, he's always views ethics more of he tells his managers to evaluate every action that they take, and not just by legal standards, but what he's calling this newspaper test. So when managers have any doubt whether a decision or action might be right or wrong, he encourages them to think, imagine how you'd feel if it was reported the following day in the local newspaper and read by family, friends, and neighbors. The bottom line would be if it passes that test and everyone thinks that's fine, then it's probably an okay action. And if it doesn't, it's not. I was also going to mention the delicious irony of the EY employees getting caught cheating on their accounting ethics exam. So that obviously didn't end up too well. EY is obviously fined a lot of money, but the question back to this again is, could you really live with yourself knowing that you cheated on the ethics for your accounting qualification? It seems like a poor choice. Just check on time. I think we are actually over time now, so I will just we'll solve these out. This is just a recap of what we've already talked about in terms of how to apply the framework and why it's useful to apply that, and sort of becoming aware of issues before they come up is quite useful. Extra resources, there's links there to the actual framework itself, various principles. You might want to have a look at the casebook and the conduct quizzes. There's learning labs if you actually want to go more in depth than this, which can be quite good too. It's more like giving voice to values. So it's not just regurgitating the codes and standards, it's actually getting into how you might apply ethics, which is actually the hard bit, standing up and saying, no, that's not okay. Otherwise, thanks everyone for your participation.